People are buying cryptocurrency, even though it's known to be volatile, and many people want to profit from its rapid rise. They ebb and flow for a while, then rise again. Many other popular digital currencies do the same. What if you're new to the market and want to get a piece of the action but don't know where to start? Start investing in cryptocurrency by following these steps. Also, be on the lookout for these things. 5 steps for investing in cryptocurrency. If you want to invest in crypto, you need to make sure your money is in order first. That means having an emergency fund, having a manageable amount of debt, and having a wide range of investments. Crypto investments can become another part of your portfolio, one that may help you make more money in the long run. Make sure you pay attention to these 5 other things when you start investing in cryptocurrencies as well. 1. Understand what you're investing in. As you would for any investment, make sure you know what you're getting into. If you want to buy stocks, you should read the prospectus and do a lot of research on the companies. It's a good idea to do the same with any cryptocurrency, because there are literally thousands of them, they all work in different ways, and new ones are being made every day. You need to know the reason for each trade. It's true that many cryptocurrencies aren't backed by anything at all, like hard assets or cash flow. People who invest in bitcoins, for example, only hope that someone else will pay more for the asset than they paid for it. Crypto assets, on the other hand, have to depend on the market becoming more optimistic and bullish for you to make money. This is different from stocks, where a company can grow its profits and drive returns for you that way. Some of the most popular coins are Ethereum, Dogecoin, Cardano, XRP, and so on and so forth. Solana, too, has been a huge hit with people. So, before you invest, think about both the upside and the downside. If your money isn't backed by an asset or cash flow, it might not be worth anything. 2. Remember, the past is past. Many new investors make a mistake by looking at the past and extrapolating that to the future, which is not a good idea. Yes, Bitcoin used to be worth just a few cents, but now it is worth a lot more. If the growth doesn't happen as quickly as it did in the past, will it still happen? Investors don't look at how an asset has done in the past. They look at what it will do now. What will make money in the future? Traders who buy a cryptocurrency today want to make money in the future, not in the past. 3. Watch that volatility. People buy and sell cryptocurrencies all the time, and the prices can change a lot. Rumors could make them fall quickly in a matter of seconds, but they could be based on nothing more than a false story. That can be great for people who know how to make quick trades or who have a good idea of how the market works and where it could go. If you're a new investor who doesn't have these skills or the high-powered algorithms that make this happen, it's a minefield. It's a game for Wall Street traders who have a lot of money. Each one is trying to outdo the other big investors. A new investor can easily be crushed by the high volatility of the stock market. People who are new to trading get scared when there is a lot of volatility, so that's why. During this time, other traders may come in and buy on the cheap. Traders who know what they're doing can buy low and sell high, while people who aren't so good can buy high and sell low. 4. Manage your risk. If you're trading any kind of asset for a short time, you need to think about how much risk you can take. This can be especially true for volatile assets like cryptocurrency. As a new trader, you'll need to learn how to manage risk and build a process that helps you avoid losing money. And that process can be different for each person. Risk management for a long-term investor might be to never sell, no matter what the price is. The long-term mindset allows the investor to stay in the same place for a long time. Managing risk for short-term traders, on the other hand, might mean setting strict rules about when to sell, like when an investment has lost 10%. The trader then follows the rule in order to make sure that a small decline doesn't turn into a crushing loss later. First, new traders should think about setting aside a certain amount of money for trading and then only using a small amount of it. If a trade goes against them, they'll still have money in reserve to trade with when they're ready. You can't trade if you don't have any money. In this way, you'll always have money to trade with. It's important to be able to manage risk, but that will have an emotional cost. When you sell a loser's position, it hurts, but doing so can help you avoid bigger losses later. 5. Don't invest more than you can afford to lose. In the end, it's important not to put money that you need into risky assets. To put your money in things like cryptocurrency or other risky assets like stocks or ETFs, you need to be able to lose all of it. In the next few years, Money that you'll need for things like a down payment on a house or an important purchase should be kept in safe places. And if you want to be sure that you'll get your money back, the best thing to do is to pay off your debt. It doesn't matter what interest rate you're paying on the debt. You're guaranteed to earn or save that amount. The place is safe. You can't lose there. Finally, don't forget about the safety of any exchange or broker you use. It doesn't matter if you legally own the assets. Someone still needs to keep them safe, and their security needs to be very strong. If they don't think their cryptocurrency is safe, some traders choose to invest in a crypto wallet so that their coins can't be accessed by hackers or anyone else. Other ways to invest in cryptocurrency. There are many ways that traders can get into the crypto game, some of which are more direct than others. These are crypto futures. Futures are another way to bet on the price of Bitcoin. Futures let you use the power of leverage to make huge profits or losses. People who trade futures are in for a bumpy ride. Futures make crypto even more volatile. Crypto funds. If you want to bet on the price of Bitcoin and other altcoins, there are a few crypto funds, like the Grayscale Bitcoin Trust, that let you do that. So they can be a simple way to buy crypto through a fund-like product that is easy to use. Crypto exchange or broker stocks. A company that stands to profit from the rise of cryptocurrency no matter who wins could also be a good idea. There is a lot of room for growth in an exchange like Coinbase or a broker like Robinhood, which makes a lot of money from trading crypto. Blockchain ETFs. A blockchain ETF lets you invest in the businesses that could benefit from the rise of blockchain technology, so you can make money. If you buy one of the top blockchain ETFs, you'll get to see some of the biggest publicly traded companies in the field. You should also keep in mind that these companies do a lot more than just work with cryptocurrency. This means that your exposure to cryptocurrency is lessened, which means your chances of both making money and losing money are smaller. It's important to know exactly what you're buying and if it fits your needs before you buy. If you enjoyed this video, subscribe to our channel.